Good afternoon, everyone. My name is Will Tanner. I'm the director of the think tank Onward, and I have the great pleasure of welcoming you to this event, which is the third in our Bounce Back Bigger series of events looking at the coronavirus crisis and specifically some of the big challenges facing policymakers as we emerge from lockdown and start to get to grips with the recovery and growing the economy as quickly as possible back to where we were, and hopefully bigger in the coming months and years. Today's event is on an issue which policymakers have not really begun to grapple with, although there is lots of work going on behind the scenes in the Treasury and in finance houses around the world, which is the question of debt. Today's event is titled Scar Tissue: How Can We Ensure Excessive Debt Does Not Hold Back the Recovery? And I'm delighted to have three terrific speakers with us today who have a wealth of experience and I know lots of interesting ideas on this topic. They are, in no particular order, Rupert Harrison, who is an advisory member of Onward and a close friend of ours, but he, more importantly, is a portfolio manager at BlackRock. Between 2006 and 2015, he was Chief of Staff to George Osborne and served as Chairman of the Council of Economic Advisors in the Treasury for 5 of those years. Our second speaker is Peter Oppenheimer, who is Chief Global Equity Strategist and Head of Macro Research in Europe for Goldman Sachs. Previously, Peter, before he joined Goldman, worked at HSBC, Bank, and a number of other financial institutions. And our third speaker comes to us from the United States, and that's Jason Furman, who is Professor of the practice of economic policy at the Harvard Kennedy School, and among other things is the former chairman of the Council of Economic Advisors in the US from 2013 to 2017, working very closely with President Barack Obama for some of those years. So we have an extremely high-level experienced panel to discuss this really important topic. And I say really important because, as we know, firms are taking on more debt now than they have for a long time. The public sector is also adding unprecedented levels of debt, with debt to GDP ratios rising over 100%, and according to the OBR this morning, staying above 100% for the forecast period. So we are in unparalleled times when it comes to corporate and public debt. And I suspect some of the policy interventions that ministers will need to consider will be similarly unprecedented. There is talk in the city about debt to equity transfers, about debt forgiveness, and indeed questions about whether or not the government should establish debt restructuring agencies or debt management corporations in order to manage large amounts of bad corporate sector debt. And there is a very large question on the horizon for ministers and policymakers around the world about how to pay for the large amounts of public debt which is being accumulated at present. That's not to say that taking on that debt or increasing borrowing right now is the wrong response, but we do need to start thinking quite keenly and quite clearly about how we address that debt in the long run. So there are some seriously big questions ahead of us, and I hope that we can get into some of those questions today. The way in which today's session will work is I will ask each of our speakers to set out their initial reflections on the question we've set for 7 minutes at the beginning. And I'm going to go to Rupert first, then Peter, then Jason, and then we will open up for Q&A. And if I could ask all of those on the call, if you have questions, feel free to ask them in the Q&A at the bottom of your screen as people are speaking, and that way I'll just accumulate those questions and pose them to the speakers as we get into a chaired Q&A after they've given their remarks. So without further ado, because I want to make sure we keep to time, can I please ask Rupert Harrison to come in first? Thanks, Rupert.
Thanks, Will. So as the first speaker, I'll try and kind of set the scene for I think, two crucial questions about public sector debt, corporate debt, and maybe kind of frame how I think we, as policymakers, we can think about those two challenges and some sort of things we might, a sort of framework we might put in place to think about how to deal with them. I mean, in a sense, setting the scene is important because if we've had a kind of huge shock to our economy, both supply and demand, debt is a useful device. You know, it's absolutely the right thing to do at this point for both the corporate sector and the government to be running up debt to support demand, to prevent scarring to the economy, both through unemployment and corporate bankruptcies, and to smooth consumption over time. So debt is a kind of good thing. And in a sense, it's interesting to focus on public sector debt and corporate debt in the same discussion, because in a sense, it's almost a sort of economic identity that these two are in some sense is substitutable. So in one reason that governments are incurring huge debts is precisely in order to reduce the amount of debt that the private sector would need to accumulate, and maybe given state of public sector balance sheets and global interest rates, it makes more sense for governments to do as much of that as possible at this stage. So it's kind of interesting to think about the sort of relationship between the two as well. It's also a particularly good time to be accumulating debt because, well, sort of three main reasons. One is the backdrop even before this crisis is it was increasingly clear we're in a period of economic history where there's just enormous structural demand around the world for kind of income producing assets. There you've got aging populations, you have very large populations in the emerging world whose countries are not very good at creating reliable stores of value. So that is a huge advantage for the developed world to create reliable stores of value for them to buy. And you know, we've seen repeatedly with sort of this downward drift in interest rates now for sort of at least 3 or 4 decades, that kind of structural demand for income producing assets is a sort of important backdrop of the world in which we live. Secondly, on top of that, we're now in a deep recession around the world, or just coming out of it maybe, and there's added to the structural demand is a cyclical demand for safe assets. And then finally, in the absence of inflation constraining central banks, we've also got central banks adding to the demand. So it's pushing interest rates really a lot, quite far out the yield curve, close to zero. So it's a good time to be accumulating debt for now. But therefore, starting with the public sector, kind of what are the limits? Is it sustainable? Are there side effects? And what might the policy response be? I think that all these, I've talked about the sort of backdrop for why the backdrop is particularly supportive at the moment. I think the central bank part of that is the one that is sort of perhaps the most novel. We've had central banks innovating incredibly rapidly over the last few months, crossing various Rubicons, potentially led by the Federal Reserve in the US, which I'm sure the other two speakers will want to talk about as well. And we have, in a sense, one of the, I like to frame this in a sense, maybe kind of particularly kind of my role, this sort of talk about what is different from the last time we were faced with a huge public finance challenge, so particularly in the UK. That was back in 2010. We had a new government. We had just come out of the financial crisis, and that period was really dominated in the UK and other countries by an attempt to stabilize debt to GDP ratios and try to get them down. And obviously we had huge debates about how to do that, how quickly to do that, what the composition of that should be. But I think that it's worth highlighting just now to start with three very important differences from 2010 and now. The first is timing. So we are still in the very early stages of this recession. If we go back to the previous time we had a huge structural hole in the public finances, so the consolidation program in the UK began on the 1st of January 2011. That was when VAT went up. New budget totals were set the following April in 2011. So that was fully more than 2 years after the beginning of the recession. So that means that the equivalent relative to now would be thinking about starting to take some measures to deal with structural holes in public finances in summer 2022. So that means even and many people, probably Jason might argue that that was even too soon back in 2010. And therefore, we are really, for the time being, for the foreseeable future, going to have a situation where the priority should be supporting the economy, preventing scarring, trying to get a stronger growth rebound as we possibly can out of this recession. And really, we shouldn't be acting now with the priority being dealing with debt. The second difference is the rate outlook, the interest rate outlook. If you go back to that period, we had 10-year government bond yields in the US and the UK over 3%. We actually had that in the US as recently as 2018. As we had, even as recently as the end of 2018, it was realistic to think that at some point interest rates might normalize around the world, and therefore governments should act, should think about risk management, about what their interest burden might be over the future. Of course, that was unsustainable. We now have, I think, a very, very different outlook where interest rates are essentially zero around the developed world, and we have central banks, which is the third thing that is very different, is central banks are now ever more determined to keep them there for the foreseeable future. And we even in countries, most countries, we still don't have explicit yield curve control. We do in Japan, and we do in maybe some of the other smaller developed economies starting to go that way. I don't think we'll go there anytime soon in the US, though maybe Peter will have views on that. But we do, I think, have implicit yield curve control. I think central banks, and if you listen to Fed communication, they talk about wanting to keep financial conditions extremely supportive for the foreseeable future and until their inflation and employment mandate is met. So that is effectively yield curve control. It's essentially saying to governments that you are going to be able to borrow at these very, very low rates for the time being. So all of these suggest that we have a lot of. I should say the other thing that I think is worth pointing out is it is probably a good thing that in most developed economies we entered this crisis at least having repaired most of the damage to structural public finances that was incurred by the financial crisis. It would have been, I think, we had a better starting point for some of the efforts that went in over the previous decade. So what are the risks, and what would the framework that we should do about it? Why would we not just carry on? Just printing money indefinitely? Why do we need to worry about debt to GDP ratios? If this is a brave new world, why should we worry about any of this? I think there's two main reasons that sort of both begin with I by coincidence. One is institutions and the other one is inflation. I think that all of this depends on the credibility of our institutions. And the fact that, particularly for, I think, an economy like the UK, which is a relatively small open economy dependent on capital inflows, we are able to do what we're doing now because our institutions, our finance ministry, our central bank, our public finance statistics are seen as credible. There is a perception that central bank would do what was necessary to meet its inflation target, and there is an assumption that at some point the Treasury will seek to assert some kind of control over the public finances. And so I think that is very important not to lose sight of that is allowing us to take these extraordinary actions. I think that I did to hear the other panelists' views that there are some emerging market economies that we are seeing remarkable combination of policy in emerging markets at the moment, a remarkable combination of loose fiscal and monetary policy in emerging markets in response to a crisis which has historically not been available to a lot of emerging markets, and which I suspect is probably quite risky for a lot of emerging market economies and may not be tolerated by markets for that long. The main impact with that would be capital flows out of those markets, weaker currencies. And in the UK has actually seen, in a sense, some of that. We've seen a big loss of confidence in the UK economy twice over the last 15 years. Once at the beginning of the financial crisis, 2008, again after the Brexit referendum. We've seen very, very big depreciations in the currency and sort of outflows of capital. We know that there's very little upside from that for the UK. We don't see elasticity of exports responding to weaker currencies. We just see higher cost of living and lower incomes. So I think that it's worth bearing in mind that those institutions, the credibility of those institutions can't be stretched indefinitely, particularly, we are not the United States. We don't have the global reserve currency. The second one is inflation. Central banks can basically carry on doing this for as long as they are not constrained by inflation. We may get short-term spike in inflation as the economy bounces back, if you get oil prices and commodities bouncing back, but that's not real inflation. And even after a decade after the financial crisis of healing labour markets and tight labour markets, it was still pretty hard to generate inflation in the US and the UK. And so my bet is that inflation is not a concern for now, but central banks should be, governments, again, it's this risk management suggests that, at some point, if yield curves were to rise, if inflation were to rise, if expectations were to change, then having taken on a lot of debt does leave you more vulnerable to changing debt interest profiles, even with mature debt profiles that we have, particularly in the UK. It would take some time for higher interest rates and higher inflation expectations to feed through into government finances. But those two risks, I think, mean that we should have some kind of risk management approach to debt to GDP. I don't think we can think that increasing debt to GDP forever is a sensible strategy. So just very briefly, I think that we should, have something like the previous framework, which I think is what we will get from Chancellor Rishi Sunak, and I think what we'll certainly in the UK will be the sort of framework, which is we should again aim to stabilise our debt to GDP ratio at some point over the next, say, 5, 6, 7 years. We don't know the scale of the challenge that represents. We don't, crucially, because we're still so early in this process, we don't know how much of this hits public finances is structural. We've had an estimate today from the Office of Budget Responsibility, which is that maybe a sort of a central estimate of a permanent hit to potential GDP of about 3%, and a permanent increase in the current budget structural deficit of about 2% of GDP. That seems a little bit benign to me. That would probably be relatively manageable and is smaller than the challenge we had in 2010. One point I'll just make about the political economy of this, I think there is a case potentially, particularly given the election dynamics in the UK. We don't have an election for 4 years, and there is a window of opportunity, I think, to put in place maybe this autumn, that get the political permission for some permanent revenue increases, and offset the fiscal impact of those with temporary fiscal giveaways to ensure that you don't have an overall tightening. I just think when you look at again, the Office of Budget Responsibility has published a fiscal sustainability report today. We do have some enormous pressures on our public finances coming down the track. The political window to have permanent increases in revenue is one that doesn't come along very often. And I can imagine that Rishi Sunak might want to say, okay, this is a moment at which I can raise some permanent revenues, and then maybe have some temporary giveaways to offset through labour market subsidies, potentially VAT cuts, capital allowances, capital spending, where there's precedent in the past that all of those things are reversible. And so when you're in the City and the Finance Ministry, you want to give away money in a way that is reversible. It isn't going to be a permanent ratchet. And so I think that there is mainly potentially a political window to get some permanent revenue raises in and offset that with temporary spending that might be reversible. And I think that that is a kind of interesting moment that as we come to this autumn. I think that that's going to get harder and harder as you get closer to an election, and as the sort of feeling of crisis, political crisis and health crisis kind of recedes. Just very briefly on corporate sector debt, which we can maybe come back to. I realise I've probably also spoken over my time. I do think this is a huge problem. Potentially for some parts of our corporate sector, a lot of companies have had to take on large amounts of debt, guarantees, to stay alive. For larger companies, this should be manageable. Capital markets are able to both provide this debt, if necessary, provide equity capital. We have pretty liquid and functioning capital markets do that for larger companies. We have big private equity and to a certain extent venture capital sector. I think there is a big problem for SMEs. The UK in particular, and Europe, but particularly relative to the US, I think has some, lacks the capacity to really provide restructuring and equity into our SME sector. The risk and return requirements for investors in that sector often won't meet some of the problems we're going to have, particularly where there's a government guarantee involved, which is going to need to be resolved first. There's a very good proposal from the City UK, which maybe we can talk about, which a lot of people, including BlackRock, have contributed to, for a sort of UK recovery corporation, providing some kind of mechanism for managing unsustainable debt through some combination of restructuring, stringing out payments over a very long period of time, perhaps through the tax system, similar to what we do with our student loan system, some version of forgiveness or debt for equity swaps of some kind. I think that the main benefit actually partly would be to the banking system, which at the moment is faced with a huge reputational and conduct challenge of recovering some of this debt from the SME sector. But I think there's also a strong economic case. And then finally, I think there's also maybe strategically a case for trying to address the kind of equity gap for UK SMEs. We don't have a very healthy sort of smaller scale private equity industry in the UK. We don't have the capacity like I think there's more in the US. There's actually an interesting body called the Business Growth Fund, which is owned by the banks and came out of something called Project Merlin back in 2011, which is a bit like what 3i used to be in the UK. They are building up capacity. They have a regional network for investing equity capital in smaller amounts. I think the government could be a co-investor in that and hugely increase the scale. I think there are other institutions like the British Business Bank and things like that that could be used to do that. And then finally, I think the other thing saying it's not about equity, but I'd be interested to hear what Jason had to say about it. I think that it's quite interesting in the US that actually the Small Business Administration has actually turned, and the sort of network of regional banks that SMEs in the US depend on, I think has turned out to be quite a useful structure. We don't really have anything like that in the UK. We think of the US as sort of the free market idle, but actually I think I'm right that 75% of small business lending in the US is supported by Small Business Administration guarantees. I think there's an opportunity maybe to turn C-bills and some of the temporary loan schemes that we've launched in the UK into something kind of more longer lasting to provide a sort of healthier financing environment for both debt and equity for smaller companies in the UK. I'll stop there.
Fantastic. Thank you, Rupert. That was extraordinarily comprehensive and took us through lots of different aspects of this problem. There are a few things in what you just said that I'd definitely like to come back to you on and just to dig into a little bit in the coming discussion. But before I do that, and I'm going to let Peter kind of come in, give us his thoughts, and please do come back on anything Rupert said if there was anything there that struck you as well.
Thank you, Will, and hello everyone from my side. I thought I very much agree with many of the comments and suggestions that Rupert has made. So rather than covering that ground, let me just say firstly where we think we are and what the economy is going to do, and therefore how realistic it is to assume that debt's going to come down anyway. And secondly, for the point of discussion, really, I like to sort of throw out a couple of areas that we think the UK economy could really focus on to generate more growth. Because I think that's really going to be the challenge as we move forwards through really the next decade. And just to remind everyone in terms of where we are right now, this downturn obviously is very global in nature for the UK. If you look at annual GDP, the biggest drawdown really since the 1700s. We're currently in May around 25% below the pre-virus peak in February for the economy. And although we do expect, like in other countries, to see a very sharp sequential rebound in the third quarter from such a low base as the lockdowns begin to moderate, I wouldn't really describe that as V-shaped. There's been a lot of discussion about this. The way to really think about this is that certainly on our forecast, we're not likely to get back to the pre-crisis levels of GDP in the UK until well into 2022. So yes, we will see very strong sequential growth in the second half, particularly in the third quarter. But there's a sort of 2-year level, level of GDP that will be missing. And obviously, going into this year, before the crisis hit, there was a reasonable assumption then that the economy would be growing each of those 2 years by around 2% or something close to it. So that is really, I think, the sort of longer term challenge. The other thing I want to throw out, not optimistic, but I think what the government here and elsewhere have done makes a lot of sense given the urgency and the scale of the crisis. The furlough schemes have been extremely successful. But they will fade, and there's 12-13 million people on the furlough scheme in the UK. According to surveys, up to 30% of people on those schemes are worried about losing their jobs. I think according to the OBR, it's likely that something like 15% of those people may lose their jobs, but that would translate into roughly somewhere between 9 and 12 million unemployed, which is unfortunately going to be a legacy of this crisis, which will create challenges and also raises the importance of looking at long-term growth opportunities, which can be employment generative. In terms of the deficit ratio, as Will said, we're looking at debt to GDP being above 100% really for the forecast period, the next several years. It's not realistic to expect that to come down in any meaningful way, given the economic backdrop that I mentioned. The deficit ratio in 2020 will be about 18%, so that's close to the levels we were seeing at the end of the Second World War. The other challenge is that while hopefully, the infection rates slow and we have much better control over it here and elsewhere, around the end of the summer and into the autumn, there will also in the short term be disincentives to investment uncertainty in this country, in particular given the end of the transition period in terms of Brexit. We can talk a little bit about that perhaps in the Q&A if it's interesting, but I think it's also important to say that that's another factor that people are not focusing on so much now, but will perhaps create some uncertainty as we get through to the end of this year. Well, this is a crisis that sort of came out of nowhere, an exogenous shock, but it's important, I think, also to look at how crises sometimes can create opportunities. And let me just spend a couple of moments on that. You know, with this newfound increase in debt, which has become absolutely necessary, you know, one of the points I would emphasize is that this isn't this country doing it in isolation. All of our competitors are doing the same thing for the same reasons. And together with the fact that, of course, as Rupert mentioned, interest rates are extraordinarily low, the lowest levels that they have been really since the 1700s. Having these higher levels of debt is not an immediate problem. I think the real focus will be on growth. Obviously, short-term growth to try and make sure that that rise in unemployment is not structural. But I think, given the scale of the shock, we should, and the transition from Brexit, we should be talking very much about medium-term strategic objectives here. There are really two that we are very focused on and think are a great opportunity for the UK in particular. I would describe them as the two Ds, digitalisation and decarbonisation. And I know these things are often talked about and bandied around, but they are absolute imperatives, I think, for the UK to focus on if it's going to not just survive, but prosper in the next decade. You know, there's lots that we can talk about here, but in terms of investing in digital infrastructure, even as you know, we think about telecom infrastructure, for example, the telecom operators in this country are generating returns below the cost of capital. And I think removing regulatory barriers to allow for consolidation in this sector would create a much more supportive environment for longer term investment. That would be one thing. I think also aligned to that, it's really important to ramp up the digitalization across those that are being left behind. And we've seen that, of course, in this crisis, particularly with people who are not able to go to school. And we think a lot in the short term could be done to give access to broadband connections, particularly to those on free school meals. But longer term, I think, you know, the government should also focus on the education sector. It's a big strength of this country. We think that the government could fund an accelerated shift to online learning, things like unbundled degree courses marketed aggressively to global student populations, you know, and really trying to focus on the UK having a university degree system that's the most digital in the world. And that we think is possible. Also in the term, along the lines of digitization, and fitting a little bit with some of the things that Will said about recovery funds and the structures of 3I and so on. We do think that there needs to be a lot of focus now on small to medium-sized businesses. Obviously, a lot of the loan guarantees have helped larger companies, which is extremely important. But we shouldn't bear in mind that 60% of all private sector employment is in small businesses. Creating government-sponsored platforms to enable SMEs to sell their products, access important software packages, for example, receiving technical support, and specific tax rebates would be really important to do. Other countries are beginning to do that. Canada, for example, its so-called digital Main Street is one model that comes to mind. Equally, potentially having the government invest directly in core patent technologies and give firms free access to that, conditional, of course, at some levels. Again, there's some interesting models being employed here. In South Korea, their intellectual discovery fund, and France, China, Japan also. So I think there's some things there that we should certainly be focusing on. The other thing on decarbonisation, again, not to spend too much time on this, but I think this is an absolute imperative, and really somewhere where the UK has an opportunity to really lead the debate, as it already has been doing really quite successfully. You know, globally, according to our analysis, to reach, you know, 2030 on a sort of decarbonisation schedule, globally, we think there's an investment opportunity of around $16 trillion. Now, obviously, that's not just the UK, but the UK could be very much involved in that. Green infrastructure is 1.5 to 3 times more capital and job intensive than traditional energy developments per unit of energy produced on our estimates. And I think that means that there are also very good prospects for long-term employment as we move more to a decarbonised economy. And the analysis that we've done, for example, suggests that even on a conservative basis, there's a potential for an extra $2.25 trillion in the UK economy over the next 20 years to reach those decarbonised targets. The UK has a very good opportunity right now with the COP26 presidency to really lead that debate, galvanise support for carbon trading and so on. But we feel that, obviously we can get into specifics, rather than really trying to think about how to get the debt level down in the near term, which is not that realistic given the scale of the shock. And given that this isn't the UK doing it alone, but you know, this is a sort of global shift in policy at a time when interest rates are this low, we should really sort of harness our focus on upscaling the digital infrastructure in this country, and at the same time really investing in a decarbonised future. I'll leave my comments there, Will.
Peter, thank you very much. That was fascinating, and it's just really refreshing to get a perspective from the kind of world of kind of investment firms, and well, Rupert obviously also reflects that view, but really fantastic to hear your thoughts. Jason, can I come to you next? I suspect you will focus partly on what's going on in the US, but you may, I mean, your review of digital competition in the UK obviously gave you some up-to-date views on the UK economy as well. So I suspect you'll be able to some extent straddle the Atlantic. But I'd love to know your thoughts on this question of specifically kind of corporate and public debt, if you have any thoughts.
Great. And another time we can talk about digital competition, which I think your government is doing a really great job on, and really leading the world with its efforts. I'm going to speak probably with greater confidence than I have, and not with a lot of qualifications. So please add a modicum of qualification to anything I say about the United States, and a lot of qualification to anything I say about the UK. Normally you fly to a country, you read about the country on the plane, and by the time you arrive in the country, you're an expert on it. I took Zoom, so that only gave me a few minutes to become an expert on the UK. So I'm even more disadvantaged than I'd normally be. On the other hand, I'm not jet lagged, so that has at least some benefit to it. I'm gonna make, I think, 5 points, although I may end up making more than that. My first point is that the shock we're seeing to our economies right now is a very peculiar and unique combination of shocks, which leads to a complex policy response. And I think of the shocks in pairs. In part, it's a demand shock. People lose their jobs, or they're afraid about their future incomes, and that leads them to spend less. In part, it's a supply shock, because people can't spend money in the United States on baseball games. I suspect you can't go to a cricket match there either. Restaurants are closed, or maybe only seating half tables, etc. You just can't produce things in the normal way. We're seeing a liquidity shock. The solution is, well, I'll talk about the solution in a moment, which is just you're temporarily out of money. But you're also seeing a solvency shock, which is in some permanent basis, you're in a negative place. And then finally, you're seeing a stop-start shock. That's not a standard term, but I think of it as what happens when you have a hurricane or a natural disaster. Everything closes for a finite period of time, and then it reopens exactly the same as what it was when it closed. But we're also seeing a reallocation shock, which is businesses will go out of business, businesses will shrink, new businesses will emerge. The first pair of shocks in each of those pairs, a demand shock, a liquidity shock, and a stop-start shock, are very much solvable with policy tools. Monetary policy can help some with lower interest rates. Fiscal policy can help quite a lot. And in the United States and the UK, we have protected disposable personal income. I think it's true in the UK. I know it's true in the United States that disposable personal income is up in the second quarter of this year relative to last year. That's amazing when you have a devastating shock to an economy, but with transfers, you can maintain disposable personal income. So we can largely solve the demand shock. We can largely solve the liquidity shock with lending programs. As Rupert said, a lot of ours built on an infrastructure we already had through the Small Business Administration. We've stood up some new ones. You've stood up some. In many cases, even just the expectation that there'll be lending helps. For example, in our state and local government bond market, the municipal bond market, interest rates were rising, spreads were widening. The Fed said it would buy muni debt, and those spreads just fell right back down to normal before they bought any. And I think at this point, they've bought something like 1 billion from one issuer. But just by saying they would do it, they solved it. Stop-start shock is something we've done less in the past with policy tools, but you give temporary transfers to a business to get through a finite period of time, and then they come at the other end. The problem is we don't have great tools for the other shocks. The supply shock, the main tool we have is test tracing and isolation, is treatments and vaccines, is intelligent social distancing. But we don't really have anything else for the supply shock. For solvency, there are workout and bankruptcy procedures. That's a quite good system in the United States, but it's a system that gets congested. And if a lot show up at once, if you can't get debtor in possession financing, if court systems get clogged, a lot of value can be lost into it. And a reallocation shock is probably the hardest and the most persistent because it says you lose your job, you don't go back to your old employer, you may not even go back to your old industry. You need to find a new job, a new industry, and the like. Maybe job training programs help, job search and the like, but the main solution to a reallocation shock that we're aware of, unfortunately, is time. And it's a long, painful slog, and one reason why I think a V-shaped recovery is unlikely anywhere. For that first column of shocks, the demand shock, the liquidity shock, and the stop-start shock, debt is a really important part of the solution. And that brings me to my second point, which I think is very much in agreement with Rupert, that right now the biggest threat we have to our economies would be a fear of borrowing, not borrowing itself. If we are afraid to borrow, we will not get through the demand shock, the liquidity shock, and the stop-start shock, and we'll end up in a much worse position economically. I think a lot of that borrowing should take place at the national level because the national governments in the US, the UK, and other countries have much lower interest rates, much greater space to borrow, and in effect, they're borrowing on behalf of other entities. If you give a transfer to an individual, that's not technically a loan, but insofar as they're going to have higher taxes in the future or lower benefits in the future, it is sort of like a loan. And it's because you have more capacity. Lending, either through central bank programs or more direct subsidized lending programs, are doing that for the corporate sector. In the United States, one place we've done insufficient is state and local governments have a much harder time borrowing. They face, notwithstanding the Federal Reserve programs, they still face higher costs than the federal government does. They face balanced budget requirements. It makes sense for the federal government to effectively be borrowing on their behalf. I, a decade ago, had the mentality that politicians love to spend, they love to cut taxes, and so there was a political bias towards deficits. And that as a policy person, you needed to lean against that political bias and sort of scold people whenever you had the chance, because left to their own devices, the politicians, at least in the United States, I'm sure yours are completely responsible, but ours would be irresponsible. My views on that have changed a lot. I've observed the last decade in playing to type. I will take Rupert up on his offer to make the point that he said I would probably be making. I think the United States and the UK, again, I'm more confident for the US than the UK, did too little of a fiscal response. I think both of us went into exit mode from that fiscal response too soon. In the United States, for example, we extended unemployment insurance benefits in 2008 when the unemployment rate rose to 5.5%. We got rid of those extended benefits in 2012 when the unemployment rate was still 8%. In some sense, politicians had this time dependence. You know, we've done this for 4 years. Do we need to do it anymore? Instead of what they should have had, which is state dependence, which is an 8% unemployment rate calls for extended unemployment benefits. So far, countries around the world have had an extremely robust response. The Germans are not being very Germanic in their response to this. There's very little in the way of ideological debates right now about the cost of the additional government debt, sovereign debt that is being incurred to deal with this. But I'm absolutely terrified that the worm is going to turn on that. It will turn prematurely and will shift into austerity too soon. And I'm especially worried because my mental model for what goes on in the economy is that it will be a long, prolonged period of recovery, that the initial recovery will be fast in the sort of reverse check mark sense, and then the recovery will be slower. So my second point is that we have to be afraid of too little borrowing, too little fiscal action, and that there'll be a premature bias of tiring of it. My third point is that we want to think about debt differently now than we thought about debt a decade ago. When I was doing the Recovery Act in the Obama administration in the beginning of 2009, real interest rates were 2%. Now real interest rates are minus 0.5%. So we actually have more fiscal capacity today to deal with this than we had a decade ago, notwithstanding a higher debt level. I've been on the dovish side of fiscal debates, and when I debated with my friends, they would say, well, what about the cost of capital? I'd sort of point out the cost of capital is quite low. They'd concede that point. They'd talk about future generations. I'd talk about some of the complexities in thinking about generational issues, with future generations being faster, and you have to look at what the debt is for, and interest rates being lower than the growth rate. And the argument people would always then come to would be, well, what if there's a crisis? We won't have the capacity to respond to the crisis. Well, the United States has a lot higher debt. It hit a crisis, and it has had no constraint whatsoever on its capacity to deal with the crisis. The UK has had no constraint, Europe as a whole, in part because the ECB appears to stand behind countries like Italy and have had no constraint. The interest rate fall isn't temporary. I wouldn't point to what interest rates are now in the month of July, but I'd look at what they were before this. In the United States, before this shock, 10-year Treasury was at 2%. I think the 10-year Treasury there was at something like 80 basis points before this shock. That was, as Rupert said, the culmination of decades of decline in interest rates. I don't have a confident prediction of interest rates going forward, but most of the causes of that decline in interest rates are likely to be even more true in the future than they are now. Weak demand for investment, high appetite for low risk securities, increased savings, low productivity growth. All of that, if anything, is more true now than it was true before. In a world of low interest rates, not only is the cost of debt lower than you would have thought, but the costs of debt reduction are higher. Now, for everyone that worries about quantitative easing distorting asset markets, that lower rates of return leading to reaching for yield and excessively risky behavior and causing bubbles in financial markets, well, if you have too much debt reduction, you're going to lower your interest rates. In some sense, the very same objectives that people are making on financial stability grounds to QE also apply to deficits. So you want to think very differently about it now. My next point, my fourth point, is on risk management. I think we do want to have some risk management. I think that really is important. I don't think modern monetary theory is true, or at least I think it's like a stopped clock, and it might happen to be true at this particular moment of the day, but a couple hours from now, it's going to be growing increasingly untrue. So I think there is risk management. I think risk management is not absolute. In our financial system, we don't say we want banks to hold so much capital that the chance of a crisis is zero. We accept some chance of a banking crisis in exchange for the extra growth you get from lending and the like. I don't think we want to cut the chance of a fiscal crisis to zero, nor do I think there really is a way to cut the chances to zero. I think you want to do trade-offs. I think that risk of a fiscal crisis depends on countries. I think it's been, in some sense, I've been hearing it for decades, and I've grown increasingly impatient with the argument. I think it applies more to the UK than the United States. You had a bit of a scrape in the 1970s. I can't think of an example where we've had a bit of a scrape, and it seems like when we blow up the global financial system, it leads people to want to buy more treasuries, not less. So the rules may apply a little bit differently here, but I think there are some rules in terms of risk management. Some of the risk management is not debt and deficit reduction. It can also be the way you borrow. We could be shifting to longer term borrowing and locking in the low rates, relatively low rates on 30-year debt. They're higher than the rates on short-term debt, but they have a insurance component to them. So there's a debt management, not just a debt level to risk management. My next point is on, my last point is on where we want to stabilize and how we want to think about stabilization. I don't think debt to GDP is a very useful concept. I've used it a lot myself. I probably just used it over the course of the last few minutes, but I don't think it's that useful a concept because debt is a stock and GDP is a flow. In some sense, you want to compare a stock to a stock. What is the net present value of US GDP? The Social Security actuaries estimate, I think it was $3.8 quadrillion. Don't often get to talk about quadrillions in events. If the interest rate is lower than the growth rate, then the present value of GDP is infinity. Debt also, of course, is backward looking. It's not forward looking, and it doesn't tell you about what your obligations are in the future. What might be a better concept is to look at real interest payments as a share of GDP. That gives you a flow concept in the numerator, a flow concept in the denominator, and takes into account effectively that debt levels may be higher now than they were before, but also interest rates are lower now than they were before. And when you combine the two of those, you find that real debt as a share of GDP in both the United States and the UK is lower and is projected over the next couple of years, even with the run-up in debt, to be lower than where it was 15 or 20 years ago. Ultimately, if you want to stabilize interest payments as a share of GDP, and interest rates are roughly flat, you're going to need to stabilize debt as a share of GDP. The question is where you want to do that. I find that question a perplexing one that I don't know the answer to. Japan obviously has extremely high debt levels and very low interest rates and not a lot of problems that I can trace to their debt. The UK for centuries had debt of 250, 350% of GDP, but you're a slightly larger empire than you are now, or even than the United States is right now. Borrowing capacity seems to be quite high right now. In terms of a few clues on where you might want to stabilize the debt to GDP, there's looking at those other countries. There's thinking about what it means for real interest as a share of GDP. There's making sure your economy isn't dynamically inefficient in the sense that you don't want your interest rates lower than your growth rate, because that implies you have a free lunch you're not taking advantage of. And there is the idea that the right response to a shock is that your debt should be a random walk. It should ratchet up and then stay at the new higher level. Combining all of that, I come to the very extremely unscientific view that I would be perfectly comfortable if the United States ended up with a debt to GDP ratio of about 150% of GDP. That would apply a real interest to GDP ratio roughly in line with the historic average in the last 60 years. If I were advising the UK, first of all, I would do more than 10 minutes of thought about this topic before I gave any advice to the UK. And second, I'd come up with a number that I think would be lower than 150, but I think would be higher than 100. And I think I'd be quite comfortable with interest rates where they are now, with it being higher than 100. And in fact, I'd be nervous about having lower debt than that, because it would lead to lower interest rates, more financial instability, and more evidence of a dynamically inefficient economy. What would the US and UK need to do to get there? Let's say the growth rate is 1.5 percentage points higher than the interest rate. That's roughly consistent with the OBR and the CBO. Let's say you want to stabilize the debt. Let's say it's 125% of GDP for the sake of argument in both countries. That says you can have a debt to GDP ratio of, deficit, a primary deficit of about 2% of GDP. Both of our countries have primary deficits that are more like in the 4% of GDP neighborhood, so some adjustment is needed. So that would be my last point, is we don't, to sort of recap them. Number one, a peculiar combination of shocks. Borrowing is an important part of the answer, and doing it on a sustained basis. Second point, we can't afford not to have a vibrant fiscal response that I'm worried will be doing too little, not too much. The third, in an era of low interest rates, you need to think about the debt differently, and you basically need to be less worried about it than you were before. The fourth point is that risk management, it makes sense, but you don't want to overdo it. You don't want your risks to be zero, and you can manage risks not just with lower deficits and debt with your borrowing policy. But the fifth point was you do want to stabilize at something. I don't know quite what you want to stabilize at. I think it's triple-digit debt as a share of GDP, but that would be a much more congenial interest payment, which is a flow as a share of GDP. And even to get there will take some work for both the US and the UK, work that I would love to see include additional revenue as part of the solution, but I don't think there's a huge hurry to do that. Thank you.
Jason, thank you very much. So we're now going to move into the Q&A section. We've got about 20 minutes left. I've got a bunch of questions, and I know that there's been 5 or so already asked in the Q&A, and I'd urge anyone who still has questions to put them into the Q&A now so that I can see them and ask them before we close. But before I come to some of those public questions, I'm actually going to ask whether Rupert in particular wants to come back on anything Jason or indeed Peter, but there are a few things that Jason said which actually, I'm really struck by the degree of consensus in the room that actually, to a large degree, borrowing is not something we need to be particularly hawkish about right now, but we do need to think quite hard about where the thresholds are for and what type of thresholds we keep in mind as we think about, especially on the fiscal side, some of the kind of public debt, and what you described, Jason, in terms of debt service ratios is exactly where the debate seems to be moving in the UK as well. But I'd love to hear what Rupert says first. I might ask Peter to come back too, if that's all right, and then I'll open up to other questions. Rupert.
Yeah, sure. Thanks, Will, and great comments from the other two speakers. I mean, I think in relation to what Jason said, I think it is it's striking, given that we have had our, I would say, relatively mild differences in the past while we were both in government on fiscal policy. Actually, we come to very, very similar conclusions, even to the point of numbers. So in the sense, we both think that there should be a goal to stabilize debt to GDP levels at some point. The priority is now. In the UK, that is clearly going to end up well above 100% of GDP. And so therefore, somewhere in the range between 100 and 150 seems to be, you know, let's not be too precise. Like I say, we've got a similar conclusion there. The estimate of the problem that scale of the problem that I cited based on the OBR numbers was, say, something of the order of 2% of GDP, although I suspect it might be a bit more than that. Like very similar to Jason's kind of rough rule of thumb from thinking about growth rates and interest rates. And similarly on debt interest rule, I agree. I think that the UK government, interestingly, now has a debt interest as a share of revenues ceiling as part of its fiscal framework, and I think that actually should become the primary, probably the primary way of thinking about sustainability in the UK, particularly as we do already have very long maturity debt. So the average maturity of UK government debt is actually already 15 years, which is incredibly long compared to a lot of other developed economies, and therefore gives you time to respond to changes in your yield curve. I think that just one thing to point out is it was good to hear Jason acknowledge that it feels different thinking about fiscal sustainability when you're sitting in the UK Treasury than when you're sitting in the Treasury in Washington, because as he says, when the world falls apart, everyone rushes to buy Treasuries, and the dollar rises, and it can be very, very different when you're in a small, open, developed economy that is not the United States. So when you were sitting in the Treasury in the second half of March, and suddenly the pound falls through the floor, and yes, there were some idiosyncrasies there about market functioning, but you feel like, okay, we're more vulnerable to the sort of unpredictable vicissitudes of capital flows. And as Jason mentioned very kindly, we have had our own issues with the IMF in the past. So it's clearly not impossible for a country like the UK to get into trouble, and therefore the kind of risk calculus, and I think this is something that's sort of under acknowledged in the US over the last decade. The risk calculus does feel a little different when you're sitting in London than when you're sitting in Washington.
Thank you. Peter, did you want to come back on anything that Jason said?
No, I think very.
Oh, sorry, you're muted again, Peter.
Apologies. Yeah, no, I think a very, very interesting point. I think there is a bit of a consensus that the environment that we're in allows and indeed demands, in a sense, higher debt levels, both because of the urgency of the current crisis, but also where interest rates are. And there's lots of reasons why interest rates are where they are, which we don't have the time to go into, but some of it is long-term structural trends, which Jason talked about. The only two things that I would kind of emphasize is, and this has been touched on already to some degree, maybe we should be issuing very long dated debt, because the demand for income generating assets is huge in our own domestic pension funds, insurance companies, and so on, aside from many foreign investors as well. Many countries have already done that and issued 50 and 100-year debts at extraordinarily low levels of interest rate. And I think that might be something that would be prudent to do. But the other point, which I guess I was trying to raise in my comments at the outset, is that I think the issue with debt is critically, what do you do with it? If you're investing in something that's going to generate a long-term return, and I think there are things that we can identify that would do that, which actually the UK is quite well placed to be able to do for lots of reasons, many of its actual comparative advantages, I think that's where we should be looking at this, not as a problem, but as an opportunity.
Understood, and you helpfully pointed to two such opportunities earlier, which, for what it's worth, I think Onward's research would entirely endorse and agree with. So I'm going to come to some of the questions in the Q&A, some of which relate to one another, so I'm going to kind of ask some of them together, but just following on from that discussion, and perhaps I can just ask this one specifically to Rupert, unless Jason and Peter wanted to come in on it, which is about the political arguments around debt. So back in 2010, 11, and as this question kind of notes in David Cameron's memoirs as well, there was lots of store placed in some of the work done by Reinhardt and Rogoff, looking at the relationship between debt to GDP ratios and public debt and growth rates. Is the view of this panel, and I'd love to know specifically what Rupert thinks on this, but others too, is the view that the unique circumstances that we find ourselves in now, the fact that all countries are increasing their levels of debt and the very low interest rate environment, does that render that type of analysis, which has obviously been subject to some debate anyway, is that no longer as relevant? And politically, how should, so we have a Conservative government at the moment, how should they be talking about debt, given the fact that some of these same politicians were saying that high rates of public debt were problematic only 6-7 years ago? So Rupert, if I could come to you on that one in particular.
Yeah, I mean, I could go back to some of the points I made in my opening statement about what's different between now and 2010, but maybe just a couple of, to answer those questions directly. You know, I think that the Reinhardt and Rogoff result is something where there was a very heated debate within the economics profession. I'm a huge fan of Ken Rogoff's and Carmen Reinhardt's. You know, the truth is, if we want to get, you know, there were two papers with the main result around debt levels being bad for growth, and one of them had errors in. But I don't think there's been a literature since then showing that has not, you know, totally made that result go away. There is still some evidence that high debt levels in some circumstances can be bad for growth, and I think that that's at least a cautionary tale. But that was never for us the main justification, and certainly for the coalition, for the reason, you know, it was really what Jason referred to and what I referred to. It's about risk management, and about, okay, what is the right balance, or what's the right amount of risk that you're willing to take? What is a sustainable level of debt, and therefore what are the kind of actions that you need to take to make it sustainable? I think that the key thing that has changed, and I think that this is difficult for politicians to explain, is that we are in a different world where now all countries are operating at higher levels of debt with much lower interest rates, and the prospect of those interest rates staying low for longer than anyone thought in 2010. So there is more ability to bear the debt. There's necessity to bear the debt. But I think you will hear, and we are already hearing from, you know, Rishi Sunak, I'm sure that, you know, anyone who sits in number 11 is conscious of the need to show that there is a plan in the end to restore some kind of sustainability. They're very conscious of the fact that the UK is potentially vulnerable to people thinking, okay, if the UK institutions can no longer deliver sustainable public finances, then there will be a price to pay. And so I think that, you know, that we will get, and that's what I was talking about there. You know, I think there is potentially a sort of political window this autumn to, you know, as Jason pointed out. I mean, I'd be interested to ask Jason this question, but if I'm allowed to, but, you know, all economies are facing some very, very large pressures from the cost of aging populations. Healthcare is a sort of rising cost as societies get richer and older. We've got net zero transition costs, some of which will have to be borne by government. And so there is a need to raise revenues, sustainable revenues, in many, many countries around the world. And that is politically very difficult to do. And so when you have a window to do that, I think it's important to take it. I mean, it's very interesting I'm very interested to know what Jason does, if he's got a 1 minute answer. I know we're for time. You know, after this coming US election, there are some very different combinations that could lead to very, very different fiscal outcomes. I'd be very interested to hear from Jason, like, what would be, if we get a Democratic clean sweep in the election, is there any appetite in the Democratic Party in the US to bother at all about fiscal sustainability? Or is the attitude that, well, if the Republicans are going to be so fiscally responsible, then we will too? And actually, I think he and I might be most worried about an outcome where in the US, where if you get a Democratic president, and a Republican, at least a Republican Senate, then that is a combination that he's very familiar with from the Obama administration, where actually you could get too much focus on, suddenly the Republicans would rediscover their love of fiscal prudence, and you might get them imposing austerity on a Democrat president again against his or her will. Well, his will, most likely.
Jason, I'm going to
continue that conversation. Sorry, we're agreeing on so much. In terms of the United States, I think a Biden plus Democratic Congress means a very large recovery package of some sort at the beginning of next year. The bulk of the Democratic Party has taken the lesson that Republicans could care less about the debt. And by the way, we ran up all this debt and it wasn't a big problem. That's not unlimited, because I think people understate the power of centrist Democrats, and they will be very important voters in having something pass. Everyone knows Alexandria Ocasio-Cortez. They don't know the names of the 5, moderate Democrats who ultimately will hold the key to something passing. So I don't think that's unlimited, but I think it's large. There's a large appetite on the Democratic side for raising taxes on the rich. I think there is substantial scope for that, but I think that scope is measured more in the sort of 2% of GDP. And to go to what I said before, I think ultimately we need a net increase of 2% of GDP. If that 2% of GDP pays for other fun stuff, it doesn't help you at all. There is no appetite anywhere in the United States for raising taxes on anyone in the bottom 99%. There hasn't been for many decades now. And I think the only possibility in the next decade for breaking that would be that Social Security, our pension program, will become insolvent probably in about a decade. The last forecast was pre-COVID, was for 2035. And maybe you could make the case to people that they should pay in more to get more out of that system. But otherwise, I don't know how you raise taxes on the bottom 99%. And then in divided government, the answer is you just get very little, if anything. That's an easy one.
Thank you, Jason. Peter, I'm going to come to you just actually on that point, just following on from what Jason just said. We've had one question about taxes and the likelihood or desirability of wealth taxes in the UK. It feels like the debate about kind of raising revenue raises has yet to really pick up, although it is coming, and there are lots of people arguing that now is a moment to reform the tax system in order to make it more equitable in different ways. What's your view on some of these questions? And if the government is going to raise revenue, where should it do it, I guess is the question. You're muted, I think, Peter.
My apologies. I don't have a particular view on specific taxes. I do think, though, that it's likely, just as we said, we went into, after the financial crisis, to some form of consensus in the end that interest rates should be zero and everyone should start QE, even eventually the ECB. But at the same time, fiscal policy should be tightened. And somehow we're going into a broad consensus that we should have QE and zero rates and fiscal policy should be expanded. And that's why the debate that we're talking about here is not really in isolation. This is a sort of a trend, and these things often go in cycles. In the context of that, we have been in a period of lower labour shares of GDP and growing corporate shares of GDP. And this has been true just as much or a similar trend in the UK as, for example, in the US and elsewhere. And it could well be that we start a process of modest reversal. Now, some of this may just be that it's harder for companies to make the kind of profit margins that they've had in the past. And some of that may be the reflection of higher taxes. After all, across most of the OECD countries, we've seen quite a big decline in corporation taxes over the last 15 or 20 years. And again, that's come from governments of very different political persuasions. It's just been a general trend. Within that, of course, there's a debate about the transformation of the economy as well, and the fact that many of the companies that are most profiting from those transformations in the digital economy pay a much lower share of GDP. So I think there will be quite a lot of focus on that. Of course, when it comes to personal taxes, income taxes, and others, and the others will be much better qualified to talk about this than me. But there is the question of how effective that is in the end of the day in terms of actually raising revenues. So I think that the broader balance might be to shift a little bit this focus away from declining income shares of GDP and growing profit shares of GDP to some form of transfers there, and that may well be the broader trend that we see over the coming years.
Very good. So the final question, we've only got 3 or 4 minutes left, so I'm going to have this as a final question, and I'm going to allow everyone to come back and give any final reflections in their closing remarks. Is about really about kind of development financing, I guess, and the extent to which there is a case for a UK version of Germany's KfW, or bringing together things like the British Business Bank and Commonwealth Development Corporation and various other things, in order to provide kind of government-backed development financing, bringing in private sector funding alongside. This is something we referenced in an Onward paper last week, but we didn't get into a huge amount of detail, and it's something I think that, am I right in thinking, Rupert, was discussed back in 2011-12 perhaps, but never in the BBB and BGF to some degree provide some of that kind of financing, I guess. But I'd love to know people's views on the need for the UK in particular, but Jason, to speak from a US perspective on kind of newer forms of financing, especially for things like infrastructure and green infrastructure as well, to Peter's points earlier. Rupert, do you want to come in first, and then I'll come to Peter and then Jason for closing remarks?
Yeah, sure. I mean, I covered this a bit at the beginning. I absolutely think there is a case for doing that. We've made some progress in the UK, things like the British Growth Fund, the Business Growth Fund, the British Business Bank. There's a range of kind of co-investment vehicles that kind of, some of which exist under the auspices of the British Business Bank. But I think there is a case for, basically the British banking system is very consolidated, very centralized, does not really want to lend to SMEs. You saw how difficult it was even through CBILS to persuade them to do it. It's very expensive, very low margin. I think there could be some really radical ways now. I think 2 things make it a lot easier to do now. One is we've left the European Union and state aid rules may be a bit less constrictive. It would have been impossible to create KfW from scratch within the European Union if it doesn't exist already. It was grandfathered in because it pre-existed. So I think that is one area genuinely where you have more freedom having left the European Union to do something. Secondly, technology. I think peer-to-peer lending platforms now have the technology that can make lending to SMEs cost effective at scale, and I think that's something that, with a combination of putting kind of government funding and guarantees behind it, I'm sure you could white label or adapt some of the technologies from the peer-to-peer platforms and get government guarantees into there to provide to basically fill that gap where the conventional banks frankly have just never been any good. And I do think that it's interesting that the Small Business Administration is I think a much underrated part of the US system, and we, as I say, on the right in British politics there's an idea that the US is that something like this would be incredibly statist and to be avoided, but actually given that there's an enormous system on this basis in the US, I think that slightly puts that argument to bed.
Very good. Peter, your views on this kind of development financing? You're on mute again.
Apologise. Sorry. Yeah, I absolutely agree with that. I think there is a place for co-investment vehicles, and particularly given the situation that we're in at the moment, where the government is involved increasingly in companies that it's providing loan guarantees to, and has supported through furlough schemes and so on. So I agree with that, and I agree with also, as I mentioned in my piece, about setting up, fiscal schemes, future tax credits to companies that share patents, for example, an online app sharing scheme sponsored by government. That would also, I think, be very useful. And I think in relation to the decarbonisation aspirations that I mentioned, I think there's a very strong investor appetite for sustainable projects, and this trend is going to continue. I think, green bonds, for example, long-term duration contracts for difference, transparent market for voluntary carbon credits, that would also be something that, alongside some of these other co-investment vehicles, I think would be very, very helpful to incentivize that kind of long-term investment that I was describing.
Thank you very much, Peter. And Jason, to close.
I don't have anything different to add to that question. I do think one issue we haven't talked about is not how we're going to make new loans to companies, but what we're going to do about all the loans that companies can't repay. And how are we going to handle restructuring? Is there some, mass restructuring we can do? Is it just, it's just sort of bespoke bankruptcy proceedings? How to speed up all of that, but that's sort of a bit of a down note to end on after all this inspirational discussion of the complete opposite of how to extend more finance. So we can do that next time. Plus I don't know anything about it, so.
So I highly recommend, I think it's about to be published, the City UK proposal, which has had input from a lot of financial institutions on precisely how to do that in the UK. So look out for that.
Okay. Yeah. Indeed. Yes, I think there were leaks coming out of it this morning. Thank you very much all for a fascinating discussion, which was actually much more optimistic than I was perhaps expecting from this discussion. It felt like there was a large degree of consensus that there is a case for government extending borrowing room, at least in the immediate term, and some really fascinating ideas about how to address higher levels of debt in the future, and how to manage some of those risks as we go forward. No doubt this debate will continue. We will at Onward continue to publish research and develop ideas in this space, and I'd love to continue with all of our panelists and also everyone who has tuned in for this session. We have 2 more events in this series coming up, so please do visit our website to sign up to those. But we are 2 or 3 minutes over time, so I will close the session now, give back our speakers to their busy diaries, and leave everyone to get on with their days. But thank you very much, in particular to Rupert, Peter and Jason for joining us today. Thank you.
Thank you.
Yeah.
Thanks.
Thank you.
Bye-bye.